In this episode, we talk about the types of insurance that every family should have. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to another week of the New Money, New Problems podcast. I hope that you tuned in to last week's episode where we walked through our new resource, the New Money, New Problems Change of Plans Checklist. If you didn't, I highly encourage you to check the link in the show notes where you can check out that list for yourself and some of the ways that the little, large, positive, and negative events in life can impact our finances. Before we get started with today's episode, I also want to extend an invitation. If you are in the Nashville area or surrounding areas, you know that once per year, my church, Riverside Chapel, has their financial literacy symposium. And while we did it in October of last year, we're moving it up to the spring. So Saturday, April 11th, starting at 11:30, Riverside Chapel, that's 800 Youngs Lane, Nashville, Tennessee, will be having our annual financial literacy symposium. If you listen to our episode with Rakim Sabri, author of Overcoming Financial Trauma, he will actually be our keynote presenter this year for the symposium, and we'll be doing a blend of a keynote presentation and a workshop on financial trauma. I cannot recommend highly enough that you attend. We'll put a link in the show notes as well for you to register. But once again, that is Saturday, April 11th at 11:30 a.m. Now, to this week's episode, I was thinking about the topic for this week because I was having a conversation with a high-income earning couple with whom we work about different types of coverages they had. And while evaluating those insurances, there was a crucial coverage that I found that was missing. And as we were walking through that coverage, which I will share later in the episode, they were completely unaware of its existence. And it got me to thinking just at a high level of all the different types of insurance that a person should have, right? Like if I were laying out a list, what are some of the major insurances and maybe even supplementary insurances that a person or family should consider? And that's why we're releasing this episode. So at a high level, we're going to walk through some of the people-based insurances after the break in terms of things like health and life insurance. And before the break, we're going to talk about the structural or protection-based elements of insurance for things like your car, your home, and the like, to make sure that you have a full understanding of what constitutes a thorough insurance plan. Now, we're going to start with auto insurance. And while there are a ton of different forms of auto insurance and structures for auto insurance, as odd as it sounds, it will make sense later when I say I'm not a fan of trying to heavily optimize your auto insurance. There are different scenarios where when you have things like collision coverage, there are people who will go, and if they have an older car and they look at how high the deductible is compared to the value of the car, they may reduce their collision coverage. So for example, if you have collision coverage and you have a car that's worth $3,000 and you have a $2,000 deductible on the car insurance, some people will say, hey, go in and just reduce the coverage for certain elements of your car insurance. I will tell you, for reasons that will be revealed, I prefer that people max out the coverage that they have with their car insurance, and we'll cover renters and homeowners insurance next. And after we've done so, I'll explain the reason for maxing out your auto insurance in terms of the limits that you have on your policy. When it comes to renters insurance for people who are not homeowners, this is something that is very easy to overlook. It doesn't cost that much money. A lot of times when I see people with renters insurance policies, they're typically paying $20 a month or less. But because it's typically a low expense or something you don't think about, it is not uncommon for a person not to have it. Renter's insurance is very straightforward. It's there to make sure that if the personal items that are in the place that you're renting are damaged, that you have coverage for those items. And even for people who have it, they typically will just sign up for the lowest level, so they technically have it without doing an inventory of the things that they actually have in their possession and their value. So if you're renting, you do want to, without having to go through every single piece of clothing in your closet or every electronic and thing of that nature, at least have a high level summary or overview of the value of those items, so that if you're getting a policy that says you have $10,000 worth of coverage, but your personal belongings are worth $20,000, it may be worth paying a few more dollars a month to make sure that the things that you have are actually protected and can be replaced in the event of a loss. Homeowners insurance, however, is much more complex in terms of the number of elements of the policy and what it protects. And you'll often see this broken down by the types of coverage. There's coverage A, which covers your dwelling. So that actually covers the home itself in terms of replacing the home, repairing damage to the home, and any attached structures. In this case, the most common example would be a garage. And when you have coverage A coverage, as all of us do when you have homeowners insurance, you want to make sure that you have a policy that first meets the minimum requirements and also is a replacement value coverage instead of an actual cash value coverage. In terms of minimum coverage, most carriers will consider you underinsured if you don't have coverage that protects at least 80% of the replacement value of your property. And when it comes to replacement value versus actual cash value, the difference is this. Replacement value means you're looking at a home and you're having an estimate of what it would actually cost to replace it in terms of materials and supplies in today's environment. What it doesn't do is treat it like actual cash value. And actual cash value looks at the actual cash value of the property at the time of loss. For example, you could have a home that is worth $400,000. Maybe it needs some new paint. Maybe the structure is failing a little bit. Maybe there's some cracked steps and things of that nature. But let's say that there was a total loss of that property and you had to build a new house from scratch. At least in the Nashville area, you may not be able to build a house of that size and replace it for less than $600,000. So $400,000 would be the actual cost value, whereas $600,000 would be the replacement cost. And to be properly insured, you would have to have 80% coverage on the $600,000 instead of the $400,000. And that's important, especially for older homes where you might have gotten coverage in place, but since that time you've done renovations. It's important if you're looking at the value of your home and nobody actually came in from the insurance company to assess its value, and you know that you have higher priced finishes and materials in that home in terms of the build as compared to other homes on your street. All of that warrants you having appropriate coverage when it comes to your dwelling. You have coverage B, which is a detached structure. And a detached structure could be a great many things. It could be a detached garage. It could be a shed. It could be a gazebo. It could be a fence that is very expensive to replace. And the base level of other structures coverage is typically 10% of the amount that you have for your dwelling protection. So if you have $400,000 worth of dwelling protection, the standard would typically be 10% of that, in this case $40,000 for other structures coverage. The important part here being you need to have an understanding of how expensive it is to replace those other structures. If you have a fence that is a very expensive fence, you might need to increase your other structures coverage. If you have a pool and you know that pool itself, aside from any of the other structures, costs more than 10% of your dwelling coverage, you would want to increase your dwelling coverage. A shed with valuable tools, or a place where you might keep things like lawnmowers or weed whackers, any of those things, you need to have an idea of the value, and if it is something where it would be expensive to maintain, consider increasing your other structures coverage. You have coverage C, which covers your personal property. This is essentially one part of the homeowner's insurance that is exactly the way it's structured for renter's coverage. For personal property, you need to have an idea of what it would cost to replace the personal items in your home. And it's funny, if you're a Real Housewives fan and you're familiar with this case, I was actually having a conversation with my wife because there's a couple on Real Housewives of Potomac that's actually going through a legal case right now because they're being charged with insurance fraud. They were filing an insurance claim and they were caught essentially trying to inflate the value of their personal items or claiming items that needed to be replaced that were not actually damaged. And my wife was saying, oh my goodness, this is so fraudulent. And I'm not saying that it isn't, but I am saying the process of going through your personal inventory and having an idea of cost is something that you don't want to be doing after the fact. You want to know how much the shoes in your closet are so that if they're damaged, you can file a claim. You don't want to be having to try and put a list together and estimate the items after the fact. So this is where personal property comes into play with coverage C. Coverage D is loss of use, and these are the things that allow you to have some temporary replacements in the event that you cannot use your home. If you are in the Nashville area and you were a part of the snowstorms, you can actually file an insurance claim if you have Coverage D coverage to make sure that if you needed to go to a hotel because you didn't have power for a few days, that homeowners insurance can cover part or all of that bill. There's Coverage E, which offers you limited coverage in terms of personal liability. So let's say that someone is at a dinner party at your home and you have a broken step and they're coming out of the bathroom, they come down the stairs, they trip on the broken step and they break their ankle. Well, Coverage E may protect you in a limited capacity from them suing you for liability as a result of that injury, whereas Coverage F would actually cover the medical costs that they incur up to a certain amount. So you might see that you have $100,000 worth of coverage for medical payments to others. So they would sue you and you'd have a limited coverage under Coverage E for that lawsuit. And then Coverage F would provide payments for things like a trip to the emergency room or to repair that broken bone. With homeowners insurance, there's also other forms of coverage, and they often come in the form of riders. And this is something where I often see people unprotected, especially if they have precious valuables in their home like jewelry or collectibles or artwork. These are things that are often not covered in full or are not covered at all by the foundational elements of a homeowner's insurance policy. So if you have valuable artwork in your home, you might have to get that insured through a separate rider with your insurance policy. If you have jewelry, this is something that's also often insured under a separate rider. So when we have people who get engaged, for example, when I got engaged and proposed to my wife, one of the first things we did was got a rider on our insurance policy to cover the replacement value of her engagement and wedding ring. All of these elements of homeowners insurance combine to tell you the structure of a policy, but just like with auto insurance, where I recommend you get the highest limits possible, it's the same with homeowners insurance. And it's not because I think that everybody needs the highest limits possible per se, but I do believe that for most, especially high income earners and high asset owners, it is valuable to have a type of coverage that many people don't have. This is what I was talking about at the beginning of the episode, and that is umbrella insurance, personal liability insurance. And most carriers, when it comes to personal liability coverage, they will not allow you to get it unless you have maxed out policies with home and auto. So for example, if you have State Farm insurance and you try to get a personal umbrella policy, they may say, hey, you can't get a personal umbrella liability policy with us unless you have maxed out your coverages on your State Farm car and home insurance. What personal liability coverage does is it protects you in the event of personal liability. Going back to my example where someone breaks their ankle coming through your home at a dinner party, if you only have coverage for personal liability for $100,000 and they sue you for $1 million and win, that's not very useful. You now have $900,000 of your own money and assets that are potentially on the line. What umbrella policies do is they sit on top of the coverages that you have in car and auto, and they provide additional protection in the event that you're found personally liable. It could be $1 million of coverage. It could be $2 million of coverage. And this is something that is both very useful and also, thankfully, very cost effective. You can also find a lot of personal liability policies that can offer you that $1 million, $2 million of coverage for $20, $30 a month. And we often underestimate the amount of exposure that we have when we're in certain scenarios. For example, if you are a coach of a youth sports team, in this environment, highly recommend you have umbrella insurance. If you are a chaperone for a sports trip, for a school trip, highly recommend you have personal liability coverage. If you teach at your local community center, at your local mosque, if you're a Sunday school teacher, in my case, I'm a Sabbath school teacher, highly recommend you have personal liability insurance. If you have a dog, especially a very rambunctious dog, recommend you have the coverage. If you have a teen driver, if you have a pool and have people who are not in your immediate family that come and use that pool, if you have a rental property, if you have high assets in general, if you're a public figure, if you're on a nonprofit board, all of these things represent additional exposure, and as a result, I highly recommend that you have umbrella coverage. So if you're hearing this and don't have it, reach out to your property and casualty provider to see what it would cost to get a policy in place. Now that we've covered the insurances on your property, after the break, we'll cover the insurances you need on your person.
This is the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. We'll be right back.
Are you wondering what new money problems you might be overlooking in your financial life? If so, we've got great news. We've crafted the New Money, New Problems Gap Finder to identify potential weaknesses in your finances in areas ranging from budgeting, investments, insurance, and even the threat your extended family's finances could pose to your household. Please head to newmoneynewproblems.com/gapfinder to complete it today. Again, that's newmoneynewproblems.com/gapfinder to take the assessment.
You're listening to the New Money, New Problems podcast. Subscribe now at newmoneynewproblems.com. Welcome back.
Back from the break, and we are covering personal insurances you need to have that cover your actual family, yourself, or your health. And we are starting with the most basic one of all, and that is health insurance. Now, this may seem odd because you know that we cater this podcast to first and second generation high income earners. And you're probably thinking, of course, every high income earner has health insurance. That's just as basic as can be. You would be very surprised at the number of people we come across who have decided against health insurance because they don't have access to a company-based plan, and the price of getting insurance when you are above the income levels that qualify for a subsidy can be cost prohibitive. On a personal note, this is something that has been a very big sticking point. We have been paying for the last probably 7 months about $1,500 a month for health insurance because we've had to get it off of the marketplace, and our income level as a family is above what qualifies for a subsidy. So you'll see someone who will be in a similar situation. They'll see that price like, oh my goodness, I can't pay $1,500, and they'll opt to not have coverage. I can tell you, as much as it sucks, and trust me, it sucks, that is not an option that will work out well if you're in any scenario where you have to go to even the emergency room and get an unexpected bill. So we don't have to get through really the structure of health insurance because it does not change if you have traditional policies from one policy to the next. It's just a matter of how much you're paying for your deductible, how much you're paying for your copay, what your out-of-pocket max, and the like. But the necessity of it is getting the coverage in the first place. There are people who, when faced with this scenario, will opt for instead a cost-sharing program, which are typically run by faith-based organizations. I can tell you that if you have medical expenses that are a reasonable cost, that is not something that may lead to that serious of a concern. But there are a number of horror stories out there for people who have had cancers, who have had specialized procedures that are required, and can be left in a situation where there is simply not enough money to provide for those procedures. And in those faith-based sharing programs, there is always the option for them to decline giving you coverage in a way that can't be done as easily through traditional health insurance. Next is long-term disability insurance, and long-term disability is paycheck protection. It protects your ability to earn an income if you are ill or unable to work for an extended period of time. For most policies, that's going to be 90 days or more. There are some people who have short-term disability insurance, which will cover you typically from 2 weeks up to 3 months. I don't think that you are necessarily overexposed if you don't have short-term disability insurance, as long as you have a fully stocked emergency reserves. But everyone needs some form of long-term disability insurance because for those illnesses and injuries that can extend beyond your emergency reserves, you need some type of protection. There are long-term disability policies that will pay you for as short as 2 years, all the way up to age 65 or 67, in some cases age 70. Now, when you say 2 years for a long-term disability policy, it probably reminds you of the structure of like term life insurance, which we'll discuss next. Term life insurance, if you hear a length of term, be it 10 years, 15 years, 20 years, 30 years, you get coverage on day one, and you have to die within the length of that term in order for the policy to pay. With long-term disability insurance, those years don't work the same. If you hear a 2-year term for disability, that means that it pays for 2 years per disability, meaning that you could get 2 years worth of coverage, go back to work, have another illness or injury, and it would pay for another 2 years. So unlike a term life insurance policy, which expires, that form of long-term disability policy is actually something you could own for the entirety of your working years because it can pay for multiple disabilities. Now, many of you, if you have an employer and you're a W-2 employee, you have some form of group long-term disability insurance at your employer. And if that fully covers or covers the majority of your income, that is a very cost-effective way to have coverage. You just want to be aware of the potential shortfalls. We've done an episode on this that's more extended in the past, but here are some of those shortfalls. The first is whatever portion of the policy your company pays for on the front end, that same percentage of benefits would be taxable to you on the back end. For example, let's say that we have someone who earns $100,000. They have a group disability policy that covers 60% of their pay in the event of an illness or injury. That means in the event of an illness or injury, they would have $60,000 a year of coverage, $5,000 a month. If, however, their employer pays for half of that coverage on the front end, half of those $5,000 monthly benefits in the event of a disability would be taxable to the employee as income. So you're already receiving a 40% haircut because of the illness, but then it's cut even more because you have to pay taxes on some of those benefits. So if you know that the amount that you'd be receiving would already be a significant cut and your employer is covering most, if not all, of the policy, some people will choose to get additional disability insurance on top just to cover the taxes that are lost in that exchange. You also are someone who may be underinsured if you receive significant commissions, sales income, or bonuses, because in most cases, the only thing that's covered by group disability policies is base compensation. This is extremely important for sales. You might have somebody who has a base salary of $30,000 that typically gets $100,000 in sales and commissions. That $100,000 of income is something they depend on, but may not be covered by a group policy. Conversely, someone who significantly depends on their bonus that they receive on a yearly basis may need to get additional coverage as well if that's something that they know would put their household in a pinch in the event of a disability. The same is true with overtime hours. If you're an hourly employee, a nurse practitioner, a physician's assistant, an emergency room physician, and the structure of your pay has a base pay and an overtime pay element, individual disability insurance would have to be secured on top of your group plan because overtime is not covered. Next up, we're going to talk about life insurance, and we're going to talk about it at a high level because this is not the episode for a term versus permanent debate. What I would say is, in my experience, people often radically underestimate the amount of life insurance that it would need to protect the things that they want protected in the event of their death. So I encourage people to go through a life insurance needs calculator like the one that we'll put in the show notes to determine for themselves and let the calculator show them what is actually needed. I had a conversation just last week with someone who thought, I just need $1 million or $2 million worth of coverage. We went through an insurance needs calculator based on the things that they would want, basic elements in the event of their death. And it turns out that they needed $4 million worth of insurance. Young person, high income earner, multiple kids, wanted to make sure that college was paid for in the event of their death. And those costs can add up, especially over time. So we often encourage people to use those calculators. And then after they determine the amount, then look for the structure in terms of term versus permanent. In my opinion, it's a very small percentage of people, especially in their working years, who need permanent life insurance, but there is that percentage out there. And in another episode on another day, we'll talk about some features of your finances that would dictate a need for a permanent life insurance. There's some episodes we've done in the past about structuring your life insurance policy, which we'll also put in the show notes. But again, make sure you have the right amount. Make sure it covers you for the length of time. If you have a child that's 2 years old and they're not going to be out of your house till they're 22 years old, getting a 10-year term policy is something that's better than nothing if it's all you can afford. But if you can afford more, a 20 or 30-year term policy is something that, in addition to the amount, make sure that you're covered for the length of time that you need. Lastly, while this is rare, it is important, and in some cases, it's important for people who don't even live in your household. And this is long-term care insurance. And this is also for high-income earners who may be financially responsible for people outside of their home, like an elderly parent or elderly loved one, because long-term care insurance is the thing that I have seen destroy people's finances, regardless of how much they have tried to make sure that they are bulletproof. This is an exposure for people who are first and second generation high income earners that is not only often overlooked, but can be just truly, truly devastating. It's one thing to be giving a family member a few $100s a month, a couple $1,000s here or there, knowing that you're the backstop financially if something were to happen to them. It's a whole nother thing to be providing for long-term healthcare costs in the event that they need things like an assisted living facility, an adult daycare center, or a home-based nurse. So that you understand, when you hear the term Medicare, Medicare is something that is available for people in this country who are over 65. It's essentially an age-based health insurance program for people in this country, and there are no income limits to be eligible for Medicare. If you are of a certain age or are disabled, you are eligible for Medicare no matter what. Medicaid is something that is needs-based, and Medicaid is the only form of those two coverages that covers true long-term care. So Medicaid, in order to be eligible, you essentially have to impoverish yourself. In most states, that means you can have a home in your name, a car in your name, and $2,000. In some cases, it goes up a little higher. But anything above that has to be sold to pay for your care or just spent, period, before you're eligible for this type of coverage. The thing that trips people up, especially when it comes to trying to stay away as much as I can from the political spectrum, people who are saying, oh, I don't need that. So when they cut Medicaid, what's the big deal? The reason that's a big deal is because most people don't know they're on Medicaid. If you look at most states, it has a different name. In Tennessee, Medicaid is called TennCare. In most states, there's a nickname to it. So when they talk about cutting Medicaid and act like it's no big deal, it's because they know that most people have no clue that they're on it. That said, if you have a family member for whom you may be financially responsible, unless you want to impoverish those people and sell everything they own, they may not be eligible for Medicaid. And even if they do, there may be limited care, or if they have to go to a facility, they have to go to where the open bed may be. Now, this is not as much of a concern if you're in a major city like Nashville, but if you're someone who lives in the outskirts or a more rural area and there's not available beds in your area, you could have someone where a family member ends up an hour away, an hour and a half away, because that's where the available bed is at the Medicaid facility. Conversely, long-term care insurance exists to not only pay for long-term care costs, but to also put a fence around your assets. What that means is when a person is eligible for long-term care, that policy can pay for things like going to an assisted living facility. It can also pay for repairs or modifications to the home, like a grab bar, a lift in the stairs to make sure that someone has a motorized chair. It can pay for home health care. It can pay for adult living facilities. It can even pay for respite care, where if you or other family members have been caring for that sick individual, they will pay to have a professional come in so you can just have a break. These are the types of things that long-term care pays for. And the reason this is so important for a high income earner is because it gives you that amount of coverage so that you don't have to pay out of pocket for these expenses, because I can tell you it is an astronomical amount per month. We were working with a couple in the Maryland area a few weeks ago, and there is a site that will give you the estimates of the average long-term care and home health costs in every area that you can think of. We put in their area in Maryland. In 2025, the average home health costs were about $4,500 a month. The average facility costs were about $6,500 a month in that area. And I can tell you that is not unique. You will find that even just a basic but clean facility is going to be multiple thousands of dollars per month. And I have seen, as I've said, this decimate the finances of very, very wealthy people when not properly planned for. So even if you're younger, but you have someone in your life who's in their 60s, their 70s, and you know the buck stops with you when it comes to their financial situation, this is something, as much as it hurts, because long-term care insurance is not cheap, where you may need to explore what it looks like to get them coverage and bite the bullet now for a smaller amount than it would cost you to do so without that insurance. So that's a lot, but this is kind of the process that we go through with our clients, where they are often surprised at just how much they need to have a fully protected financial plan. These are the elements where just a thing missing here or there can lead to a claim that is uninsured or a risk that damages their finances in an unexpected way. This is also why we do things like the change of plans checklist, so you're aware of how these things can impact you when it comes to your money. As a reminder, if you're in the Nashville area, I encourage you to click the link in the show notes to register for the Financial Literacy Symposium on April 11th at 11:30, and I hope to see you next week.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.